Hello students, welcome to EPG Pathshala. I am Dr. Manjeet Singh from Punjabi University, Patiala. Today, we are going to discuss about a module on economic reforms under the paper Business Environment. After reading this module, you should be able to understand the concepts of economic reforms during the post-independence period. Secondly, you should be in a position to understand the economic reforms during 60s, 80s, 90s, and the present period. Thirdly, you should be in a position to describe the process of economic reforms initiated by Government of India. Fourthly, we should also be in a position to understand the concept of monetary and fiscal reforms. And lastly, we should also be in a position to understand the terms like trade policy, industrial policy, and their reforms. These days, Indian economy is considered as one of the fastest economies in the world. And we are celebrating 70 years of our independence. And during these 70 years, the various economic policies have been initiated which have led to the continuous economic development of the country and which has brought us to this phase where we are being considered as one of the fast developing economies of the world. If we talk in a wider sense, the economic reforms in India have been a mix of both social democratic and liberalized policies. Economic reforms during the post-independence period. With the help of economic policies, the Indian government tried to make the country self-sufficient in the post-independence period. Under the concept of economic reforms, the main emphasis was given much to the development of defense sector, infrastructure sector, and agriculture sector. Indian government companies were established and important investments were done greater on the public sector. This was basically done to make the base of the country stronger. In order to make strong the communication system, infrastructure, development of new roads, spread of rail lines, construction of bridges, dams, and lot more were considered. In the 5-year plans, which were started in 1950s, Indian economic reforms somewhat followed the principle of democratic socialist with more stress on the growth and development of public and rural backward sectors of the economy. Maximum number of policies were meant towards the enhancement of exports in comparison to imports, central level planning, trade and business rules and regulations, and also intervention of state in the finance and Indian labor markets. During the mid-50s, large-scale nationalization was made to the national level industries, that is mining industry, electricity organization, telecommunication, etc. Now let us talk about the economic reforms in the post-independence period, mainly 50s, 60s, 70s, 80s, and 90s. Though it is being said that the liberalization process of India started from 1991, but the fact is that the present phase of liberalization through which we are passing through, the seeds of those liberalization process was sowed by Rajiv Gandhi when he became Prime Minister in 1985. And if we go a little further in the historical perspective, in the period of mid-60s, various efforts were made in India to make India self-sufficient and also to increase its production and export of food grains, pulses, etc. to a great extent. All this we were in a position to attain when the Indian government started the concept of green revolution, or we also call it the new agriculture policy of that time period, which focused on better agricultural output through the usage of fine quality fertilizers, improved and hybrid seeds, improved irrigation facilities, and lot many other initiatives which were taken by the government at that point of time. Moreover, many new irrigation projects were started and rural banks were created to give financial support as well as loans at a lower rate of interest to the farmers and the poor people living in the rural areas. Now, another reason which led to the initiation of reforms during the 90s was the kind of global environment which we were facing. At this point of time, Soviet Union was in the process of dismantling, and because Soviet Union was one of the major trading partner with us, on account of that, there became a major problem of balance of payment. And because of this, the International Monetary Fund, they have asked for the major reforms. Otherwise, they said that we are not going to help you out. IMF came to the help of India by bailing out the loan which was given to India. In order to get rid of this situation, at that point of time, our finance minister, Dr. Manmohan Singh ji, started the liberalized economic reforms in the year 1991. And it is being considered as one of the major milestones in the Indian economic reform industry history, as it changed the market and financial scenario of the nation. As per the program of liberalization, foreign direct investment was invited. Major public monopolies which were created by the public undertakings, they were dismantled. Like if we talk about the telecom sector, BSNL was the major monopoly earlier. But after this 1991, many more players were invited in the telecom sector. The service and tertiary sectors were also developed and improved. Further, the economic reforms have put stress on the open market economic policies of the country since the initiation of liberalization plan during the period of 1990s. In order to get rid of that situation, the Indian government has taken various decisions like making our financial sector strong, and with more and more reforms were introduced in the banking sector which made it more robust and to make it one of the best in the world. Various kinds of reforms were initiated in the services sector, and the quality of exports were also improved, and lot many other types of initiatives were also taken by the government. 1991, a new wave of economic reforms. Economic reforms in India was initiated with the goal of enhancing the speed of economic growth, development, and eradication of poverty. Economic liberalization process can be traced back to the late 70s during the other government systems. But the reform process actually started in the big way only in July 1991. It was in 1991 that the Indian government has signaled a systemic shift to more open economy with much reliance and dependence upon market forces, a greater role for the private sector, including foreign investment and restructuring of the role of the government. The reforms of last 2 decades and a half have gone a long way in freeing the domestic national economy from the control regime one. A significant characteristic of India's reform program is that it has stressed gradualism and evolutionary transition rather than increased restructuring or shock therapy. This system approach was adopted since the reforms were introduced or started in June 1991 in wake of balance of payment crisis that was surely very severe. but it was not a prolonged crisis with a long-term non-performance of activities and various operations. The economic reform started in 1991 introduced far-reaching long-term measures that change the working machinery and the system of the economy, and it has given long-term benefits. The changes were mainly in the following fields. Public sector dominance in the industrial operations was minimized. Discretionary controlling powers on investment in industrial sector and capacity expansion programs for building a strong power. Exchange and trade control measures to be implemented. Limited access to the foreign direct investment in India, and regulation and public ownership of the financial sector and other institutions. Economic reforms have opened the growth potential of India and unleashed the powerful entrepreneurial forces. From the period 1991, successive governments across political parties have successfully carried forward the country's economic reform agenda. The Government of India has taken various steps in the respective fields. Like one of that is the reforms in the industrial policy. The industrial policy of India was restructured to a large extent, and most of the industrial controls taken by the central government were dismantled. Huge deregulation of industrial sector was made because of the bringing in the element of competition and increasing the efficiency in the industrial sector. In fact, the industrial sector became more efficient after the competitive environment which was created through the reforms of industrial policy. As per the new industrial policies, the industries were freed to a greater extent from the licenses and the other control measures. This policy led to the end of the quota Raj which existed before that. For increasing the modernization and more emphasis was given upon the usage of advanced technology. A huge reduction has been effected in the role of public sector, and private sector has been emphasized more, which is more efficient and more productive. Some important points of the new industrial policy have been highlighted here. Abolition of licensing. The Indian industries were operating under strict licensing system before the introduction of new industrial policy. But now, maximum industries have been freed from licensing and other restrictions like import and export, etc. Freedom to import technology. The usage of current or latest technology has been given more importance in the new industrial policy. Therefore, foreign technological collaborations have been allowed and technology was imported from international market. Contraction of public sector. The policy is adopted for the industrial undertakings which were running into losses, and that was not to expand them. Moreover, the Indian government is trying to follow the structure of disinvestment in such public sector undertaking, like selling some more shares of public sector enterprises to private sector entrepreneurs is called disinvestment. This is also a medium of privatization. Free entry of foreign investment. Various steps have been taken to attract and increase the level of foreign investment. Some of these are as follows. In 1991, the government's permission was not required, where 51% foreign investment in 34 high priority industries was allowed. Other non resident Indians were allowed to invest 100% in the export houses, hospitals, hotels, etc. A board named Foreign Investment Promotion Board was established with a view to speedily clear the foreign investment proposals. Various restrictions which were previously in operation to regulate dividend repatriation by the foreign investors have been removed. They can now take dividends to their native countries. Removal of MRTP restrictions. Monopolies and Restrictive Trade Practices Act had been abolished and a new act was introduced named as Consumer Protection Act. In the current scenario, companies do not need to seek government permission to issue shares, extend their area of operation, and to establish a new unit. Removal of FARA restrictions. A new act called as Foreign Exchange Regulation Act has been replaced by Foreign Exchange Management Act, which is beneficial in regulating the foreign transactions. These transactions have now become more and more simple. Increase in the significance of small scale industries. Efforts have been made to get more significance to the small industries in the economic development of the country. Now, let's talk about the reforms in the trade policy. Before the initiation of reforms, trade policy was featured by high tariffs and pervasive restrictions on import because the focus of the government was on export promotion and import substitution. But these economic reforms sought to phase out the import licensing, and it also initiated the process of decrease of in the import duties. Import licensing was abolished relatively early for the capital goods and services, and later on it also switched over to a flexible exchange rate system. Another aspect was the restrictions in terms of quantity on imports of consumer commodities and the agriculture goods, which was finally removed or abolished on April 1st, 2001. And it is almost exactly 10 years after the reforms began. And that in part because of a ruling by the World Trade Organization dispute panel on a complaint filed by United States. Trade policy can be understood as a policy with the help of which the foreign trade is controlled and regulated. Because of liberalization, trade policy has undergone numerous changes. Especially the foreign trade has got rid from the unnecessary control measures. The age-old restrictions have also been eliminated at one go. Some of the chief features of the new trade policy are as under. Restriction of export-import reduction. Restrictions on the exports and imports have almost disappeared, leaving only few commodities. Export-import tax reduction. Export-import tax on some items have been completely abolished, and on other items it has been reduced to minimum lower level. Procedure of export-import gets easier. Import-export procedures have been simplified and made more accessible. Foreign capital markets established. The foreign capital markets have been established for sale and purchase of foreign equity, currency in the open financial or money market. Full convertibility on current account. In 1994-95, full convertibility has become applicable on current account. Here it is significant to clarify the meaning of current account and full convertibility. Therefore, it has been done as under. Current account means the foreign transactions made in the international market are placed in two categories: transactions with current account, for example, import and export; capital account transactions like investment. Full convertibility. According to full convertibility is defined as unrestricted sale and purchase of foreign exchange in foreign exchange market for the purpose of payment and receipts on the items connected with current account. It means there is no restriction imposed by the government on buying and selling of foreign exchange connected with current account. On the other hand, sale and purchase of foreign exchange connected with the capital account can be carried on under the rates determined by Reserve Bank of India. Another point is giving export incentives. Numerous incentives have been allowed to the export-oriented units and export processing zone for enhancing export trade transactions. Fiscal reforms. The government policy related to the income, employment, and expenditure is called fiscal policy. The biggest problem confronting the Indian government is the massive fiscal deficit. In 1991, fiscal deficit was 8% of GDP. It is significant to understand the meaning of fiscal deficit and GDP. Fiscal deficit means that the country is spending more than its income. The expenditure is greater than the source of income to spend. Gross domestic product is the sum total of the financial value of all manufactured goods and services during a year in a nation. Generally, the financial deficit is calculated in the form of GDP's percentage. Presently, the Government of India is making efforts to take it to 4%. Solutions to fiscal deficit. For solving the problems of fiscal deficit, basic changes were made in the tax system and structure. The following are the major steps taken in this direction. The rate of individual and corporate tax has been reduced in order to bring more and more people in the tax net. Tax procedures have been simplified and accessible, and it is made online in the digital era. Heavy reduction in the import duties has also been implemented. Monetary reforms. Monetary policy is a kind of control policy with the help of which the central bank controls the supply of money with a view to achieve the aims of the general economic policy. Reforms in this policy are called monetary reforms. It maintains a balance between the demand and supply of money market. The major points with regard to the monetary reforms are given below. All the banks have been given permission or freedom to decide the rate of interest on the amount deposited on their own. Statutory liquidity ratio, that is SLR, has been lowered down or decreased. A commercial bank has to maintain a definite percentage of liquid funds in relation to its net demand and time liabilities. This is called SLR. In liquid funds, cash investment in permitted securities and balance in current account with nationalized banks are included. Thirdly, more improved standards have been provided for the income recognition for the banks. Permission to collect money by issuing shares in the capital market has been granted to Indian nationalized banking sector. Allowance of open banks in the private sector has also been granted. Another types of reforms which were initiated by the government are called as capital market reforms. Capital market is the market in which the securities are sold and bought. The reforms related to capital market are also known as capital market reforms. This market is the pillar or the main base of the economy of a country. The government has taken up various steps for the growth and development of this market. Firstly, in the portfolio investment scheme, the limit for investment by the non-resident Indian and the foreign companies in the shares and debentures of the Indian companies has been increased. Secondly, for controlling the capital market, Security and Exchange Board of India has been established. Another important restriction in respect of interest on debentures has been lifted now. Now it is decided on the basis of the demand and supply for a particular security. Another important feature of these economic reforms was that the office of the Controller of Capital Issue, which used to determine the price of shares to be issued, have been dispensed with. We do not have now Controller of Capital Issues. Now the companies are free to determine the price of the shares of their own. Permission has also been given to the private sector to come up with the various types of mutual funds products. The registration of the sub-brokers has been made mandatory for increasing the security and the safety of the investments made by the public so as to have more and more investor protection. Phasing out subsidies. Cash compensatory support, which was earlier known as or given as export subsidy, has been abolished. Cash compensatory support can be understood with the help of an example. If an exporter wishes to import some raw material which is available in the foreign country for 100, but the same material is available in India for 120, and the government wants the raw material to be bought by the exporter from India itself for protection of indigenous industries, the government is ready to pay the difference of 20 to the exporter in the form of subsidy. This payment of 20 will be considered as CCS. Moreover, this cash compensatory support has been reduced in case of fertilizers and petro commodities. The government has initiated various steps to abolish the price control in case of many commodities. Price control means that the companies will set up commodities at the prices which were determined by the government. The efforts to remove the price control were mostly in respect of fertilizers, iron and steel, and petro goods. Restrictions on the import of these goods have been removed or abolished. Financial sector reforms. Financial sector reforms have long been considered as an integral part of the overall master policy reforms in India. India has realized or recognized that these reforms are imperative for enhancing the efficiency of resource mobilization and allocation in the real possible economy and for the overall macroeconomic stability of the country. The reforms have been driven by a thrust towards liberalization, and numerous initiatives such as liberalization in the interest rate, reserve requirements have been initiated on this account. At the same time, the government has stressed on rules and regulation with the objectives of strengthening prudential norms, transparency in the system, and supervision to mitigate the prospects of the systemic risks. At present, the Indian financial structure is inherently strong, functionally diverse, efficient, and globally competitive. In the last 20 years, the Indian financial system has been incrementally deregulated and exposed to the global markets, along with the introduction of new instrument, securities, and goods. Now, let us see what we have read from this particular module. If we try to summarize it, it can be easily said that this economic reform process has completely changed the character of the Indian economy from the regulated one to the liberalized one. Various types of policies which have been initiated during the last 2.5 decades for industry, for trade, for the financial sector, all have been subsumed under the title of new economic policies. And they have really taken India from a developing country to a fast developing country. Thank you.